First of all, welcome everyone to another Ask Me Anything. My name is Phoenix Normand, and I am the chief of Tribe, which is, in my opinion, and the new marketing, the most powerful tool for top performing executive assistants. And the whole real focus for Tribe for 2021 is around education and making sure that a lot of these sort of looming questions get answered by experts. So I've reached out particularly for this particular subject matter, which is around personal investing. I get probably 10, 15 questions per week on,
Mm.
hey, Phoenix, is there a way to, maybe bring someone in, or can we maybe talk about an investment group? Or did you hear about this whole GameStop craziness? What's your opinion? Blah, 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 blah. And I'm a big believer, if I don't know what the hell I'm talking about, I'm certainly not gonna give you any advice on something that I have no clue about. So I am honored to bring in Scott Jacobs, who is a wealth advisor at a company called Mindful Money. And I really wanted someone, thank you, Maggie Jacobs, fellow tribe member, for sort of raising your hand, because I did my research, obviously, and Scott is, the dopest of the dope. Which, as you know, that's kind of my phrase, is I want the dopest of the dope around me, the dopest of the dope to sort of be the experts that we look to for advice or to answer questions, etc. And Scott is here specifically to really give us an insight into, not just personal investing. We're not, like, first of all, let me go ahead and dispel the rumor here. We're not giving you stock tips today, so calm down. What we're trying to do is to actually set the framework so that when you invest, you have the right mindset, and you can start putting the pieces together. You can get the knowledge, the experience, the tutelage that you need in order to invest in a much more thoughtful, mindful way. So all that said, I'm going to turn it over to Scott and let him school us essentially. So Scott, I usually start off with saying, hey, why don't you, give us a quick introduction and let us know who you are and what you're all about.
Sure. Well, thanks so much for having me. At Mindful Money in California, where we are, we really, we come from a place of education first. There's just not a whole lot of this in schools today. There certainly wasn't when I was growing up. And we're just an undereducated country for sure around financial services, et cetera. And so that's a big piece in the passion for Mindful Money and for myself. A little bit about me, without getting, if I go down a rabbit hole, just pull me back. But,
Don't worry.
yeah, I'm originally from New York. I moved out here a couple of decades ago, worked for all the big names, Payne Weber, UBS, Prudential, Wells Fargo, all the guys that advertise on billboards and stadiums and such. And I'm now with a registered investment advisory firm, which is not a big brand like that. And everything's client-centric now. We're not worried about quarterly earnings. We're not worried about products. It's really all about clients and getting them positive outcomes and good outcomes. And so the one thing I'm going to really try and do today, and I'm sure I'll have a bunch of questions that are coming at me, is really dispel some of the myths that are out there, and try to set the record straight on some things about historical perspective, what actually really works, what actually really doesn't, and then what kind of happens pretty regularly over and over and over again. So we kind of get a sense for not to be surprised about it. And I think we do a really good job locally, and we have clients throughout the country educating them so they can make really good decisions based on strong data. We're evidence-based, so there's firms out there that do what's called active management, and there's firms that do what's called passive management. What we do is called evidence-based investing, and I'm happy to get into some of that a little bit later if you guys would like, but it's different. It's very, very different. And so I don't, as far as Ask Me Anything, the AMA structure of this thing, I'm happy to, I don't have any particular deck to present, although I'll pull up a slide here and there if it makes sense. But I've been doing this about 25 years. I've seen a lot. I had not quite as much hair as Maggie Jacobs on Zoom, but I had a fantastic mullet back in the 80s and 90s. And so, things are not always what they seem.
I love that. And I love the fact that you use the word mullet in this conversation today. So that just makes life. So are we all breathing now? It's all good. So, you mentioned something at the head of all of this around, Americans specifically not being schooled around personal investment or just investment in general. Why do you think that is?
You know, that's a great question. I think I think education as a focus in this country, period, is something that needs a whole lot of work. Forgetting financial services.
Mhm.
I remember vividly being in college, my father saying to me, "You shouldn't go to Cancun for spring break," and I said to him, "I'm 18 years old and everyone's going to spring break," and he said to me, "You have no money. How are you going to spring break?" I'm like, "Well, of course I do, Dad." There was a credit card company called MBNA, which I think was
Oh my
my Visa.
God.
I was like, I got a free towel and a tote bag, and they gave me a credit card. I'm actually leaving in about a month, Dad. I'm going to Cancun. And what they said to me was, you should really wait till you have the money. And the truth was, it was sound advice. It really was. But at the same time, I'm 49, and Cancun is not really user friendly at 49 for spring break like it was at 18. But those are the kind of things, they're on these college campuses and they're giving out these credit cards. So there's a lot of setup in society around not having good outcomes. And an 18-year-old person who's being given a credit card is not going to listen to their parents, generally speaking, any more than I did.
Right.
And so I don't have a good answer as to why the education isn't happening. I know that it's starting to roll out. We have a curriculum out there. We have courses out there. It's really the fundamental thing our firm is founded on: education and planning.
Love it.
Not picking stocks, not picking securities, because over long periods of time, that stuff doesn't work. And I'll get into that later as well. But we have a lot of work to do in education. There's a lot of countries that are doing a lot better than us in this education around financial services and planning.
I completely agree. And the funny thing is, I was one of those college kids that fell
Yeah.
for the MBNA credit cards, and thus started my journey with debt.
Yeah.
And debt that I could not recover from quickly, because
That's right.
when you get basically given free money, especially when you don't have the teaching, the tutelage, the sort of reins being pulled on you. I think a lot of people fell into the exact same rabbit hole with
Right.
regard to credit card debt. And I feel that's, it's nefarious from the sense of, and I don't want to get pulled too far away from our
Yeah.
topic, but it's
Sure.
nefarious from the sense of the fact that these companies were even allowed on college campuses. And they their biggest consumers ended up becoming college students who were
Yeah.
already in debt from just going to college. So
That's right.
imagine personal debt on top of that. So there's that diatribe. But
Yeah.
I, I will dive into a couple of questions that I had for you.
Yeah.
So, you know, a lot of this, actually, how about this? Why don't we talk about the elephant in the room, this whole Bitcoin thing? We'll start there.
Okay.
Actually, let's change gears. Let's talk about GameStop. A lot
Yeah.
of people have read every freaking thing on the
Sure.
planet, and I think, we're not going to dive too far down the rabbit hole of like
Yeah.
what happened. I think if, my thing is Google it if you haven't figured it out by now. There's
Sure.
so many amazing things. YouTube has amazing videos breaking it down into bite-sized pieces. But,
Yeah.
I think it's more the attitude and
Sure.
the onus around GameStop, because I feel when people think about investing, they're thinking about the quick hit as
Yeah.
opposed to long-term investing, which is so much
Sure.
more, not only safe, but it's just a better way to approach investing. So
Right.
maybe you could help dispel some of
Yeah.
the ridiculousness around this GameStop thing, and hopefully pull people
Yeah.
back from the edge
Sure.
of wanting to invest in this when it's just not a
Yeah.
good move. It's just not.
Yeah. So that question has come to me in different shapes and sizes for about 25 years now.
Mhm.
And it easily could have been a question in the last 10 years. Hey, Scott, what about this new iPhone 6 or the 6 Plus, this big screen? Should I invest in Apple stock today? Or Disney's coming out with, the next whatever, another billion-dollar film. Should I buy Disney stock today? And I respond the same way. In this case, you're saying GameStop, you're maybe saying Bitcoin, but I respond the same way. The successful outcomes that people are going to have with their financial plans in the future aren't predicated on this investment or that investment at all. In fact, 93% of your success is the asset allocation. Only 7% is the actual investments themselves. 93 versus 7. So the mindset of the average consumer, they think they have to find the right investment. And that's a misnomer. The question I'd be asking myself for anyone on this call is, are your parents living? And are you now, or do you expect to become financially responsible? At Mindful Money, that's the kind of thing we do, right? It's not trying to find the right stock. And a lot of people don't realize in this country, I can't speak for other countries, in this country, assisted living or long-term care, it's $10,000 a month. A month. So you have a parent in a home like that for 3 years, that's almost $500,000. And so if you haven't planned for this sort of thing, that could create a real laceration in your financial life. So I mean, certainly we could talk about what do I think about Bitcoin? I think people need to know what they're getting involved in. And if you really don't understand what, in fact, you're getting in, you shouldn't be in it, right? And so as an example, is Bitcoin going to be a widely successful investment? We're not in the prediction business. That's not what we do in Mindful Money. We plan. We plan, we don't predict, right? And so for everyone that loved Bitcoin in 2017, when it was up at 19, 20,000 and the world chased into it, and believe me, they all did, it was down 80% within a year and it was at 3,000. And so for those who don't either know that or remember that, I want to bring that to the front of your homepage here. That's the kind of investment or investing this is. So this is not, Disney. This is not Microsoft. This is a whole different animal. I'm not here to tell you it's going to go up or down. Anyone who's telling you otherwise, they're just guessing. They're just guessing. And so it's so important, planning to us is a foundation for success. I'm not here to say buy Bitcoin or not. If I'm going to be transparent, which is my preferred choice, I happened to put a few $1,000s into this craziness a couple of years ago, because you know what? I've been doing this 25 years and I am human and I wanted to have a scratcher like everybody else. And so if this thing does go to the moon, I have a few bucks in it, but if it goes to zero, I'm fine. And so just recognize what it is. And is it going to replace the dollar? I have no idea. And anyone who tells you they do, they're also guessing. They're guessing. It's so important. So important that you don't put too much weight in what one person says, including me. Do your research and get educated on what's evidence shown for very long periods of time. That's what we lean to. And so you mentioned GameStop. Let's speak to that for a second. I just had a lunch with somebody today, and they said GameStop is up again 100%. It's back from the dead. I'm missing it again. And I said, Andrew, this was literally like an hour ago. I said, Andrew, I had this conversation with you just a few weeks ago. There was a hot craps table, and the stock went from 40 to 100 to $483 a share. And you missed the hot craps table. And then it went down to 40, and it dropped 80% in like a week. Well, it's a hot craps table again. You get to choose to stand at the craps table and play. They're not serving drinks for GameStop, but it is a craps table. It is 100% gambling. This is not investing, folks. And there'll be someone to tell you it is investing, and that's on them. So just recognize what it is. It's very aggressive stuff. Generally speaking, when we speak to families, we don't want people to be investing in things that could be up or down 50, 60, 80% in a week or a month. That's gambling. Long-term investing.
Thank you for saying exactly that, by the way. Yeah. That's exactly what it is.
Is this over time. This is not fun. It's a lot, very stressful. It becomes a mania. Hope that helps. Hope that response is what you're looking for.
Well, I think, you've said a couple of things that are landed like atom bombs. One, thank you, Maggie, for posting that. It's a very important question, especially if you are investing, if you are trying to, plan for your future, your family's future. And also plan for those emergencies. Plan for the fact that if your parents are living, they are getting older and they are going to start having medical issues. I had to help take care of my parents for a while until my stepdad died, and it was expensive. I mean, it almost bankrupted me. Like, I'll be honest with you, because I'm not deep in investing and all of this other stuff, but because I got to that point where I really understood, like, wow, this is not sustainable. Then now this investing, long term, and really looking at this as a way of, putting all my extra cash into a fund or whatever else in order to set myself up better. I still have one living parent who, last year or 2 years ago ended up with breast cancer, so it's kind of like, you just don't know. This isn't just about you. It's not just about the quick hit. It's not about, hey, let me put a couple grand in Bitcoin and a couple grand in GameStop, and and I can kind of guess or feel when it's time to pull out and go take that money and do something else with it. It's not sustainable. You can speak to that, of course, a little bit later as well. Next question. How do you convince clients to have a long-term strategy? I mean, short hits are sexy. We see them all the time on all the sort of, business channels and stuff like that.
I think that's a great question. I think there's been a real shift in the last several years. I'm not in the convincing business, actually, at all. That's not my job. My job is to meet people through an introductory type call from a CPA or an attorney, an existing client. They send them to us, and I go through a process. Once you do that introductory call, we take them through what's called an Explore Fit, where we go through a very specific agenda of what we do, what we don't do, what you should expect, what you shouldn't expect, what it costs to work with us. Very transparent. And so when we get to the point where we talk about our philosophy, what we're looking for in the Explore Fit is exactly what the title of that agenda sounds like. In this case, Phoenix, you're looking to explore fit with us and our firm, and we're looking to explore fit with you and your family. And so it's just exactly what it sounds like. And so ultimately, what we're trying to figure out is their alignment. Are you saying I want 10 or 15% return? I want to beat the S&P every year? Because if that's what you want, we'll refer you to another firm. Nobody can promise that every year. Nobody can promise it. Or I want to be in a bunch of Bitcoin. I want to buy cannabis stocks. That's not us either. And so we go through this Explore Fit process and we try to really figure out what their values are. What are they really trying to accomplish here? And so another question I sort of posed to the group, which I think is really, or a comment I think is really important. Everybody is trying to figure out what's the next Microsoft, the next Facebook, the next whatever it might be. And I would tell you, there's tons of noise. You will hear it from this conversation, last week's conversation, to your dying breath, hopefully at age 95 or later. But you can hear about what to buy, what not to buy, realistic, all these things. Here's the fundamental thing, machete through all that noise. This is what you want to ask yourself. It comes down to these words. That's it. Are you going to outlive your money, or is your money going to outlive you?
Wow.
Period. All that other stuff is noise. And there's only one way to find that out, and that's through planning. So.
Brilliant. Shelley Trask actually had a good question here. Oops, sorry, I think I lost it. There we go. My mom's financial future stresses me out much more than my own. I'm good, but how much do I need to cover her? It's a little specific, obviously, but I think it's a good question just because I think a lot of people want to know. And I'll raise my hand. I'm starting late. I won't lie. A lot of people are starting really, really late, but I'm also a big believer that just start. You know what I mean? Whatever that looks like, because you can. I'm a big believer. I can always make something happen. But again, like how in sort of a long-term strategy, especially if you're starting late, what obviously you don't want to ask specific stocks, obviously, but how do we approach that? And how do we make it less daunting? And how do we get over the narrative like, oh, I screwed up. I should have started this in my late 20s. I should have, threw money into my 401k, or I should have bought into every single IRA that I could. How do you counsel people now? I know you deal with more high net worth individuals, but having done this for 25 years, I'm sure you have some advice that you can just sort of give people, like, stop it. This is kind of what you might want to think about.
So there's a lot there to unpack. So let me see what I can do. So first, choose one. I want to speak to one comment you said. How do I start? When do I start? Just start. Yeah. So you've all heard this before, but it really is germane to here, and that is, when's the best time to plant a tree? Right, 20 years ago. When's the second best time to plant a tree today? Right. And so if you don't have an IRA, you should have one. If you don't have a 401k at work that you're funding, you should get involved in that kind of stuff. And a lot of times it's either tax deferred money, free money, matching with certain companies and corporations and agencies. So I think that's really, really important. And then I think also what ends up happening to families and individuals is we just spend beyond our means. And I think it's just a part of our culture here in the United States. I don't know if it's so egregious elsewhere. It's pretty bad here. And so I think you just got to start somewhere. And it's just opening an account with any major, house out there and start, but don't, and this is so key too, right? I always speak to this. There's too many people trying to put their rod in the water to catch a Tesla fish. I'm going to buy some Tesla and I hope it goes up. We don't invest for any family that way. We invest trying to get the hook into the school, right? So we want to own Tesla and 500 of its best friends, Johnson & Johnson, and Disney, and all these names And I do a little shout out to Unilever and some of these European countries and News Corporation, Nestle's, right? There's beautiful, amazing, profitable companies all over the world. So don't try and catch a fish. Try and put your hook into the school. You're going to have much more success that way. Diversification is what they say, the only free lunch out there. And so it's important to not be investing in individual stocks unless you have oodles and oodles of capital. And then you said something earlier too, we only deal with high net worth. That's not the case. It used to only be the case. We now have an entire education and curriculum that's for the masses, and much easier barriers of entry, And it's been a really great way to educate the public. And we'll probably get into that at some point in the next 40 minutes about this group and having some access to some of that stuff because they're on the call.
Fantastic. So why don't we take our first little, it's not even a break. Scott has brought a couple of trivia questions. So what we'll do is if you have an answer, the first correct answer in the chat will win. What are we winning, Scott?
I don't know. Do you see it?
Mindful Money, the book.
Oh, yeah, it's the book. One of my best friends and owner of Mindful Money wrote this a few years ago. It's an excellent book and really consumable for anybody. It's not this over your head kind of thing, which is kind of the way we try to create the client experience for us, for families. So just, I don't know if you got the chat going, but I'm just curious what people think.
Okay, now are you hitting us with the question? Is this the countdown?
Yeah, kind of.
Okay.
Well, I was going to say, so let's just take a picture of time. 20 years a period of time, right? Everyone in this country thinks the U.S. is the greatest country in the world. Obviously, we have a lot to learn, right? So I asked this question of anyone I interact with in Explore Fit and introductory calls and everywhere else, and I get all different kinds of answers. And I'm curious what you think. So the U.S. is what's considered a developed nation or developed country, as is France and Germany and Japan. These are all developed nations. They have their own Dow, their own index of investments and stocks. In the last 20 years, how many times do you think the United States was the #1 performing developed nation? What? Smart crowd, actually.
I know, right?
I'm really impressed. So I heard an answer actually this week of 20. I've heard 15 to 20 a lot. I hear 10 quite a bit. It is very, very rare that someone's down around 0 to 5. So I'm not sure what this crowd is doing, if they're Googling this stuff, but this is impressive.
It was too quick to Google, so don't worry.
The answer is the United States has been the #1 developed nation in terms of performance one time in the last 2 decades.
Mel Aiken, I see you, girl.
So I say this because there's so many people that think investing internationally means you're investing in some like rinky-dink Thailand cement company. And that's not what you're doing. The only time the U.S. was the #1 performing was 2014. And I believe we were up about 12 and some change percent. So whoever, I'm not sure who was closest, but basically.
That was Mel.
Yeah. So you know where this is going. I'm going to put this on the side.
I do. I'm going to have to grab it for you. I'll send it out because Mel is overseas. So I'll send it over to her.
But I just want to speak to this topic for a second of international investing. We are global investors. And so constantly I get asked all the time, what do you think of the market, Scott? The market's expensive. The market's this, the market's that. And I respond the same way. Mr. and Mrs. or whoever, what market are you talking about? You're talking about the Merval in Argentina, the CAC in France, the Bovespa in Brazil. What are you talking about? And so we're so myopic in our view, they don't realize that there's a whole globe of investing out there. And so I mentioned that in 2014 was the only time the US was #1 out of all the developed nations, Germany, all these names. I think there's an interesting story to be told, though. Everyone knows in this country and globally, 2008 was a really tough time for markets globally. Global real estate financial meltdown, real estate, et cetera. Okay. 2009, however, was a great recovery year. And I want to speak to this because it goes back to international investing again. We were up 26% in 2009. We were coming off a really hard 2008. So the recovery usually is pretty violent on the upside as well to recover from the down, right? So here's where it gets really interesting. Even when the United States does very, very, very well, up 26%, that year in particular, 2009, there were 16 countries out of 20 that outperformed us anyway. So just to hit the point home, this is not just about the United States. There's a global investment community out there with lots of opportunity, and we are completely global investors at Mindful Money. So we have at least half our assets for clients, depending on the family and with dynamics, overseas.
And let me ask about that. Like, for instance, for a lot of us, we're sort of noobs, and we're going to be, really kind of trusting, for instance, someone like you to sort of let us know what that's all about. I'm a big research fiend.
Yes.
So, I don't just take anybody's word at law as law. I need to
Yeah.
research it. I need you to give me
Yeah.
sort of some,
Sure.
an idea about that. So, for instance, I know nothing about foreign markets. I know a
Yeah.
little bit, obviously, because I'm in my research, but I know
Sure.
nothing about foreign investments particularly. So,
Sure.
is that something that you really sort of drive home? Hey, here's the portfolio or the fund that we're suggesting for you. You mentioned you guys are big on education. Is that something where you would then send
Oh
them not just information, but like say, hey, really research this and see if it feels right to you, that sort of thing. So I'm curious if that's kind of your protocol, or is it more leaving kind of giving people the names and being like, there's Google, have a good
Yeah,
day.
it's an interesting question. Part of the Explore Fit process, I will ask a family or an individual, and I'll say something like, "There's going to come a time in our relationship." In this case, it was COVID most recently. There's going to come a time in our relationship that the advice that I'm giving you is going to be completely counter to what you want to do. Your amygdala, your fight or flight's telling you the complete opposite of what we're telling you. And this is before their clients. I'm prepping them to see if they're coachable. We're going to be asking of you at that moment is to take the advice we're giving you, if for no other reason than it's ours. And therein really will determine where the relationship can go. Because we had this happen. It's a great example. A couple doctors in the middle of COVID. This is like March and April. You don't expect that the relationship to be so tested so quickly. It was like 6 months in, and we had a 28-day drop of almost 35-40%. The reason why it was so violent is because I don't say no one, people forgot that markets go down. The last time we had a drop like that was 2008, 12 years earlier. So people got complacent and forgot markets go down. Normally, those drops are every 5 years. It had been 12 years since it happened. So these two doctors, one of them, imagine this if you could, he's wearing the mask, he's wearing head to toe, he's got a face, he's got a shield, he's like going to war.
Mhm.
And they're not panicking, but they're like, look, I get what you're saying, markets drop temporarily, and you believe because of evidence, blah, blah, blah. But Scott, you don't understand. Like, we're on the front lines, and all we see is sickness and death, and it's going to get much, much worse, et cetera, et cetera. And I literally went right back to what I told Dan and Chris. I said, listen, guys, remember that conversation at the Explore Fit meeting? We're going to ask you to take our advice at some point in the relationship. And I repeated it. And you're going to take that advice, hopefully, for no other reason than it's ours. Well, guess what? That moment is today. And so they ended up sticking to it. And my favorite part about that story is because of the education we do, we did not have one family, and I feel great about this. We didn't have one family liquidate in March and April because we're on Zoom calls, we're educating, we're showing them evidence, we're showing them whatever, and being there for them to let them understand that we're going to have a tech bubble again. We're going to have a terrorist attack. Hopefully not, but that kind of stuff's going to happen. And the name of the horror movie or the scary movie, it keeps changing, but the downdrafts are similar, And so I think what also people don't realize is the 10% correction game happens every 12 to 14 months. So with the Dow Jones in this country at about 30,000, that means any given year, I think everyone needs to hear this part, any given year, it would be totally normal for the Dow to be down at 1.3 thousand points. Normal. And that's just, I'm not making, this is not my opinion. This is just facts. This is what's happened for 100 years. Part two of that, 20% correction. Now you're talking about a 6,000 point move. Those happen every 5 years. They're not to be feared. They're to be embraced. And the only other punchline to this I'd mention is in March and April, 35% of 65-year-olds liquidated to cash. And that's a study that came out. I don't know what they're doing now. The Dow at 18,000, now it's at 30,000. But it's the behavior is going to get you in trouble every time.
Yeah.
It's not picking the right stock. It's being in the right stuff and then getting scared out of it. And your overall investments actually do better than you did because you never stuck through the investments. Does that make sense?
It does. And it reminds me when I was a realtor,
Yeah.
is, really following those cyclical trends. They happened, especially in real estate, they happened to pretty much every 7 years. We used to call it the 7-year cycle, meaning, you would have a really, really hot market.
Yeah.
It would do well for, a while, and then it would drop. but then it would
Yeah.
come right back up, and you would have another 7 years of
Yeah.
for the most part, growth. Because look at housing prices, for instance.
Yep.
Actually, thank you, Shella, for bringing that up. Housing prices will fluctuate a little bit, but historically, if
Sure.
you're looking at them now, they're
Yeah.
higher than ever. My mom's house, we
Yeah.
bought it for $300,000 in the late '90s. It is now
Yeah.
worth 1.7 million bucks because we rode the market and we continue to stay in the house, as opposed to
That's
freaking
right.
out when 2008 happened, when I lost
Right.
my house. So
Of
it's
course.
that's just one of those things. And I think,
Yeah.
maybe as part of what you guys teach is really removing the emotion from this. This is
Oh,
tactics. This is not emotion. And my thing is, if you're emotional, that means you've got, I don't want to say too much money involved. Maybe that's not the best way of putting that, but you really need to understand that these fluctuations are going to happen. That's part
oh
of
yeah.
a market that no
Yeah.
one can control. There are no
That's right.
reins attached to a stock market. Sorry,
Yeah.
guys, I don't care where you are. What you can do is, look at the data, and sort of
Right.
see what that actually looks like. So I want to also mention to you guys, if you have very specific questions that you'd like to ask Scott, please type them in the chat. I have several sort of pre-prepared ones, but this call is for you. It's not for me. So
Yeah.
if you have questions, please, by all means, dump them in the chat, and I will ask them as they arrive. Um, Here's another question for you. Investing has always sort of been perceived as, you know, haves or have nots type of thing. How would you dispel that myth to with a new investor? I mean, I grew up in a family that we didn't talk about investing. We didn't talk about savings even. I mean, we were
Yeah.
a debt family, and it took me forever to break
Yeah.
out of that. And my mom is like the world's greatest investor now, by the way. If you guys
Yeah.
need someone on your team, let me know. But
Yeah. Yeah. I think it's a great question. I think that's a great question. I'm going to give you like a little case study here of a particular person. Not going to tell you who it is, but it's a real person
Mhm.
I know very well. So here's a person who's was a school teacher their entire life. They never made more than $70,000 their whole life. And what they were doing was they were investing way back in the beginning, and they were putting 5%, 10, whatever it was, right, in diversified portfolio mutual funds, and they were just rebalancing and holding them for decades. This person today is probably 79-ish. They're worth over a few $1,000,000. And it's because it's time in the market, not timing the market. Money will compound and grow dramatically when you start putting it away. And I think anyone who's on the call that's done that, meaning, put $100 a week, away for a number of years, and they turn around, they have a six-figure account. That's what happens. Money will grow over time, but you've got to put it away. And the only reason why this particular person or people like this person have this nest egg at the end is because they put it away. Nobody could put it away for you. And it literally starts with $100, $50, and you just keep doing it. And trust me, you will not miss it. Most people will not miss it. I can't speak for everyone's individual situation, but it's so important that you just put the money away.
Yeah.
Yeah, I think that's really his case study is great because he's been doing this for forever. And the idea that he never made more than $70,000 his whole life, his peak earnings was $70,000. I mean, and yet I've met people, and I bet you people on this call have met people that made 200, 300, 400 a year, and then have a pot to piss in. So I've always had this conversation, intro calls or exploratory. You show me someone making, it's not what you make, it's not what you make, it's what you save and what you spend. You show me a family or individual making 300, and I'll show you someone spending 400, right? So it's definitely not what you make.
Yeah.
People get by with a lot more than what you would imagine. I've seen it many times over.
Mhm.
And I'm guilty of this. I sometimes have leased a car I shouldn't have and spending too much on things. And it's all trade-offs. If you're spending it now, you're not going to have it later. I'm not saying don't spend, but be mindful of it and have a plan that shows what the budget accounts for and that you're going to be okay later, with a roadmap, some kind of GPS and navigation that in, what's today's date, the 24th in 2021 of February, that you're going to be okay in 10 years, in 31, in 41, and 51. That's what planning is. And the truth is, no one's going to be talking about GameStop in this conversation.
Next week. Sure.
Decades from no one talks about Enron anymore. That's a bad example, but this is what happens. The markets do what they do,
Well, Enron is, a cautionary tale.
Yeah, of course.
Obviously, people chasing that quick cash and dumping it in and believing soothsayers who are feeding them a bunch of BS. for their own agenda, and we saw what happened. Actually, I want to dovetail off of that, something that you
Yes,
said.
sure.
Actually, you know what? Let me not do that. Let me go to the questions. Someone brought up gold. Hot
Oh,
topic.
that's a good one. That's a good one.
Yes, and you and I
Yeah,
kind
yeah.
of chatted about that in our pre-call. So
Yeah,
let them have
so
it. Give the kids, give them the kids the truth.
I find it fascinating. And I'm still a student, and I've always been a student of this game, right? So I did a little project. It couldn't have been more than a year or two ago, maybe less. I've been hearing about gold forever. It's not been a thing for me. And so I just decided to do a little research. And anybody could do this. That's the brilliance of Google and the internet in 2021. It's all out there. It's all out there. So here's what I learned. I learned in 1980, gold was $800 an ounce. In an eerie version of similarity, the Dow Jones was about $800. Well, I haven't checked today, but gold's probably about 1800. So from 800 in the 80s, right, 80 to about 1800. The Dow's not 1800. The Dow's not 2500. It's not 5 or 10 or 15 or the Dow's over 30,000, folks. So where's the conversation here? I don't even know what we're talking about. No, I'm being serious. I have no idea what people are talking about. If you're a long-term investor, why would you invest in that stuff? I mean, and I have no idea. Oh, 1810, somebody said. Yeah. So,
which is
I
nowhere
don't know
near
what the
30,000.
conversation. I do not know what the conversation is.
Right.
And we don't own it. We don't own it for families.
Yeah, and I don't see the
Yeah.
upside. I don't think I've ever seen the upside of gold, to be honest with you. Except to wear. But
Yeah.
that's an upside. But
Yeah.
as far as an investment, I'm not really seeing that. Let's see. Oh, Deanna had a good question. Do you recommend changing strategies at certain milestones? For instance, 250K versus 500K versus, a mil. God forbid, I'd love to be in that echelon.
Oh, that's an interesting question. I actually don't think it's so predicated on the assets themselves. I think it's really on the family dynamics. Do you have to send a kid to college? Do you have to save for an aging parent? Are you saving to buy a second home or a first home? And so what is the landscape of your current situation when the dollar amount hits that, that bell? But I don't know that I would be, here's the thing, maybe this is a better way of explaining it. 20, 30, 40 years ago, you used to work for a company called Sears, which is still actually in business, I think, or GE, or whoever it was. And you worked for these companies for 30 years. They gave you the corporate watch, the watch. They thank you for everything. You retired and you were dead within 10 years. Right? So you spent less than 10 years in retirement. In 2021, what's happening is people are retiring, and depending on when they retire, they're actually spending more time in retirement than they actually spent working. And so there's a whole new dynamic around this. And I think that's really important because I saw somebody mention target date funds in the chat. Our industry does a really good job of creating products that the public wants that they not necessarily need. And so target date funds is a perfect example. Target date funds, for those who aren't aware what these things are, they usually have a title: Vanguard Target Date 2050, Fidelity Life Cycle Target Date 2035. And the title, in theory, is supposed to be when you want to retire. Here's the issue, and going back to what I said, retiring at 65, and now people are living to 95. They're getting you more and more conservative. So when you hit 65, you're basically in bonds. So here's the problem with that. If you're going to be in bonds from 65 to 95, how are you going to keep up with inflation? The 10-year treasury right now, the bond, is paying literally less than 2%. And so
that's less than like a good interest-bearing savings account, right?
No, it's a little higher than savings right now. But the point of this is there's a lot of people that are in these target date funds, and they don't realize that when they turn 65, they're not even practically in the stock market anymore. And so if you're only going to live for several years, that makes sense. But if you've got 3 decades of time, runway to 95, you sure well better have a way to keep up with your purchasing power. Everyone on this call, I think, remembers, and I'm from New York, so I'm a bagels and pizza guy, and I'm a Jewish guy from New York, so I'm definitely a bagels guy. And so, it's one of those things where think about what a slice of pizza, because inflation's a word that gets spoken about too much, and it goes everywhere else. What does it really mean? Well, what did a slice of pizza or a pie cost where you live? And what did a bagel cost when you were a kid? And then think about what it cost today. I can only speak for me because it's my experience. You could have bought a slice of pizza for $1, and bagels were like, I don't know, 25 cents or 50, whatever they were. To put cream cheese on that bagel today is triple what the bagel cost. And to put topping on a slice, outstrips the cost of the slice way back when. And the point is, everybody's worried about the market going up and down, and that's the dragon they're worried about. They want to slay that dragon, the market volatility. Let me tell you, the market's going to do what it does. And it's going to do this. For long periods of time, this is exactly what it does. It's very clear what it does. The dragon to focus on is to protect your purchasing power. Knowing that your dollar in 20 years is going to be worth 50 cents, that's something to worry about. That's something to be very worried about. So your assets need to grow to keep up and be commensurate with the increase in the cost of everything you do. Make sense?
Does to me. Here's a question. I've been hearing this a lot lately. FIRE, financial independence, retire early. That's of course being bandied around, especially in a lot of tech-centric locations, just because a lot of these tech companies are paying 200+K to engineers, et cetera. And they're all, I think, again, this feeds that whole make your money fast kind of BS. And I'm just curious, what are your thoughts on that? And is it something we should be trying to dispel as opposed to jumping on board with? Or
I think everyone's got to do, you do you. I mean, I just heard this from one of our doctor clients recently. She was thinking about this, where she just cuts back on all her spending and really lives on a whole lot less so that she can retire a whole lot earlier. And if that works for her and her plan, bears out that the plan works and she has money at the end, great. And if you retire sooner, even better. I don't know that there's a right answer here. I think everybody's different. I think some people can have a really hard time tightening the belt as much as FIRE is telling you to, and really, living in this austerity lifestyle. But then there might be people that just really like that and want to do that. So I'm not a for or against. I think it's really whatever fits you and your family dynamics and what makes sense. I think at the end of the day, the less you spend, the more you're gonna have later. I'm not saying don't go out for dinner with your friends. I'm not saying don't go buy a great belt or a great blouse or a great top that you like, or take the vacation you should. It's all about planning. And so if you've got a plan that supports your income and all these expenses, and I'm even talking about Spotify and iTunes, I'm talking about Netflix, I'm talking about all these Costco annual membership. What we find when we do this expense analysis for families, not you shouldn't do this, you should do this. They forget that $5 and $10 and $15 a month doesn't really add up in the near term, but over decades, it's a fortune, right? It doesn't mean don't do it, but account for it and plan for it. And so we get really granular, we get really forensic in our planning process. So everything's on the table. This is what it costs for you to be you. What is that going to look like in 2041 and 51?
Right.
And how are we going to have your income, your Social Security, the tax consequences, all speak to having a positive outcome to support all of this dynamic and landscape, right? And so, again, that's why when people ask about what to buy, what to invest in, what to this, what to that, what they don't recognize is your outcomes aren't connected to the success of what you pick. It's not at all. It's about planning, and don't be greedy with Bitcoin 3 years ago at 20,000 when it went to 3 next, or cannabis a couple years ago, or tech bubble style, and don't be fearful like tech bubble, terrorist attack, COVID, and get out of the market. And this is please everyone just put it in your pocket. There is literally no supporting evidence going back 100 years that a downturn means get out, ever. Every single decline has been temporary, and we've been greeted with all-time new highs in the future. Yeah. The average decline is about 16 months in this country. The average expansion is about 5 years. So I think another key phrase here, in order for you to participate in the market's permanent advance, you must get comfortable with those temporary declines.
And not bolt, essentially.
And not bolt.
Yeah, brilliant. Someone asked me, I want to make sure I include this question. She asked me last night, what if you, made one of those investments, or, a series of sort of individual investments, and you see, you get that 200 to 400% return. What it's kind of a weird question. Again, you've probably already answered it, but
Yeah,
what would you do? I mean, would you basically, reinvest that money, or would you, take a little bit out, go on a vacation
yeah,
because maybe that was the reason why you got into investing in the first
yeah,
place? Is that something that people, should do, especially in the current market?
sure.
Or is it just better to, to let it ride and figure out a different way to, pay for your vacation? Because of course
Yeah.
that
So,
money
so,
that
so when
money
I hear,
doesn't come
when I,
back.
when
It's
I,
you
yeah,
lost.
yeah, that's a great. So when I hear a phrase, "let it ride,"
Mhm.
it sort of brings up like, the
Gambling
track.
again.
Yeah, yeah, yeah. So I wouldn't use that phraseology. What I would think more about is when people invest. If you're not going to invest in a globally diversified portfolio, which is what works over time, it's not sexy, but it just works. If you do it your own way, if you're going to invest in individual security or a Bitcoin or whatever it might be, whatever real estate, art, whatever it might be, go in with a buy discipline. I'm going to buy this asset at this valuation because it's attractive, but then go in with the same expectation of what is my sell discipline? Am I taking an X profit when it gets there? If it goes up and then drops, I'm out. Like, have some kind of sell discipline when you're in there. And I think that's another big issue that I don't think the average consumer does. Everybody can invest in anything. It's what's your sell discipline. And so I'll give you an example of what happened in March and April for us. So markets dropped in about 28 days over 35%, give or take a few percent, depending on what you're looking at. And so you had a few options as us, as a consumer, as the average, Mr. and Mrs. whoever's out there. Here's your options. One, hold your nose, right? Two, liquidate in fear. Three, buy more. Or four, what we did. What we did was rebalanced. So let me give you an example. And someone said buy high, sell, buy low,
I saw
sell
that.
high.
Yeah.
Right, right. I saw something like that in the chat.
Yep.
So let me give you an example of what we did. So bonds were temporarily up double digits because everyone ran to bonds out of fear. So what do? We have a pie. Clients have stock and stock funds and bond funds and cash. That's the allocation, right? So we had double-digit returns briefly for no good reason. I mean, we knew why, but it was not really warranted and fair. We sold bonds at this temporarily high. And then we looked at this wild sale in the stock market. Things were down 20, 30, 40%. We took from bonds, rebalanced, and bought more stocks. So what happened? We lowered our cost. We're buying more shares of these depreciated assets and stocks and stock funds that were down temporarily. So I mean, that's really opportunistic rebalancing. And so if you're constantly doing rebalancing, you're literally constantly taking from the rich, if you will, the outperforming, and rebalancing in the underperforming. And that's what you do. And over and over and over again, you rinse, repeat, and do it tax efficiently. Not sexy, but successful over time.
And that's maybe, sort of like subcontext to this conversation is, a lot of the right quote unquote thing to do isn't
Yeah.
sexy. It's not,
Right.
the Gordon Geckos. It's not, all the movies
Right.
that we've seen and,
Yeah.
I loved. And I was in investment banking. So for almost 11 years. So I saw all of that insanity. And, it was quite sexy. I won't
Yeah.
lie. I was spending a lot of the company's money on parties. And these were amazing
Right.
parties because we
Sure.
had a lot of money and some great
Yeah.
clients. But I think that also sort of set people up, with this
Yeah.
sort of preconceived notion that stock investing has to be sexy. It has to be
Yeah.
go all in or man or a mouse kind of thing. And I think now that we're sort of we're a little bit older and a lot wiser,
Yeah.
it's I think we should in some way try to make long-term investing sexy. I
Yeah.
don't know what that looks like from a marketing perspective necessarily, but I applaud the efforts of you and your company just because it is kind of sexy to think, hey, the investments that I make right now, the sort of sacrifices, quote unquote, that I make
Yeah.
by not going to all the parties, by not flying to the Seychelles because they're still open because of COVID to US, stuff like that. Like I have a friend that went to the Seychelles and spent $20,000 where I'm just like, dude,
Yeah.
you that money would have been so much better in an EFT or just something
Sure.
other than you go into like a resort that's probably kind of whack anyway. So
Right.
let me jump on another couple of quick questions because we
Yeah.
are running out of time. And I also want to make sure we get that extra. Actually, why don't we do that right now? Let's get if you have your second trivia question
Sure. Let's
handy,
see. So
let's get
yeah.
that knocked
So
out.
I'll prep the question by saying this. All too often, I hear people say things like, let's just speak to the U.S. markets for a second. The markets. I'm going to wait. The market's high. I don't like the market here. It's expensive. It's overvalued. All this, that, and the other. And so that's going to lead to this question. Let's go back like literally almost 100 years, 75 years or so. How many times, well, percentage, what percentage of times is the S&P positive going back to like the 40s or 50s? What percentage? 30%, 50%? What percent is the S&P positive versus negative going back literally 75 years? Wow, good, good, good. These are great answers.
I love it.
Yeah, these are good answers.
Let me know when you get the right one.
Well, that's not gonna. Ooh, Samantha, very close.
Did she get it? Oh,
80%. I mean, I don't know how it all works, but basically, out of the last 73 years, 54 have been positive. So what does that mean? That means that 74% of the time, 74% of the time, the S&P is positive. So let's speak to that for a second. And I guess you know who won that, Samantha. I think she gets that. She gets the. So let's speak to this for a second. When someone is actually saying the opposite of that, I think the market's expensive. I think it's going to be a bad year. It's not going to work out. I'm going to lose money. What they're actually saying is, I'm going to invest in a place and a way that the evidence supports that I'm right basically 25% of the time. That's ludicrous. So again, it's all about the evidence. What does the evidence support? The evidence does not support being short for a long period of time. And that's just a whole other conversation, which we're not going to have time for today.
you know,
But I want there to be a takeaway there. 74% of the time, folks, the markets are positive in this country. A big number.
I mean, that's insane, especially when you look at other countries and the volatility that they have based on GDP, based on wars and all this other bullshit that we're not kind of, strapped with any of that.
Media is not helping.
It's well,
they're not going to be average. They're not going to be talking about somebody, saved some kitten in a tree. It doesn't sell advertising. It doesn't sell. If we have time, remind me at the very end, I've got a story about CNBC and a woman by the name of Susan Krakow. If we have time, I want to bring this up.
Susan Krakow, I know that name.
Yeah.
I wanted to ask this one question. Really around like housing, not housing, but real estate, for instance. It seems like it's right now. It's actually still a good market for real estate. At least what I found in the Bay Area, based on apparently with everything going on, I think people were expecting there would be some sort of market drop, especially around real estate, but it's actually turned out to be quite the opposite. So I'm curious, how do you feel about real estate as an investment right now?
Yes, that's an interesting question too. So most of our clients, as you might imagine, are homeowners. So to us, it's just another asset in their pie, right? Yeah. We're not going to sit here and tell you is we like real estate. We don't like bonds. We like stocks. Oil looks cheap. Tech looks expensive. Because what's that? That's predicting. We're not in the predicting business. We plan. And so if I don't think real estate is any different than any other asset, art, stock, whatever it might be. If you buy and invest in an asset and you hold it for very long periods of time, and the price when you purchase it is the right price, you're going to do very well. It's the timing of this thing, trying to get in a house and out of a house, the flipping of this stuff. I mean, it's just gambling on a different scale, and it's not for the faint of heart, kind of thing. So I don't think people should be buying homes. At least my parents didn't buy a home to make money. They bought a home to have a place to call home for their two kids, to raise us and whatnot. I think when you're buying a home to make money, I think you're looking for an exit already. And I think you buy a home to enjoy it. If you want to be a real estate tycoon and something, that's a whole different animal and a different genre. And there's a lot more education. It's not like, ordering a pizza and saying, you know what, I don't want pepperoni. Let's put on, extra cheese. It's not liquid as much as the other markets. And, but it's not a bad thing. But just recognize it's not something where you should be trading in and out of it. Like, if they were showing the value of your home price like they do a stock ticker, I think it'd be really unhealthy, because no one's really looking at the value of their house. I think even social media and Zillow has made it worse. People are checking out the value of their house way too often. Yeah. And so I just think it's a mistake. It's a long-term investment. It should be called home first. If you want to own other properties, but they shouldn't be short-term sighted. Right. Hold these things for a few business cycles to realize the rate of return you should get. Any few years, anything can happen. I think that's been really clear out there.
That's brilliant. Okay, we are quickly approaching the time.
Mhm.
I'm just taking one more peek through. You know what? I do have one quick question for you.
Yeah.
Let's go back to the whole starting late thing. I want to leave people with something of
Yeah.
that's a little bit more tangible.
Mhm.
If you're starting right now,
Mhm.
what would be a good way to start?
Yeah, I think we touched on this a little bit earlier. I,
We
I
did.
think I would be, if you work for an employer, I would see what kind of retirement plan you have there, and that's a great place to start. See if there's a match. That's a great place to start. If you are working for yourself, I would talk to your CPA and whether there, SEP IRAs and other vehicles you can create to write off expenses and things and actually participate in a tax deferred way. Because how neat is it to have no money in an account and then $100 and then 1,000 and then 20 and then 50 and then 100 and all that growth is completely tax deferred to your 59 and a half, right? I mean, so that's a really good, I think, way to get that going. But you also, before you do that, I think someone's mentioning here, emergency fund. I think that's important too. You got to have money on the side. For us, when we speak to families, clients, minimum of 3 months, sometimes more like 6, sometimes 9, and at least 12 months of emergency cash. So when the market declines temporarily, you're not drawing on investments that are temporarily down, but you have an emergency. That's why it's there,
Mhm.
for an emergency, for a COVID when it happens. You're not drawing on investments that are temporarily declined, and then you give them the opportunity to recover. And so the emergency fund, I think, is very, very important.
Brilliant.
I think that's Carly, I think, mentioned that. I think it's super important, and not enough people have one.
Yeah.
I think that's a big one.
Well, like, let's be honest, I don't think people are going to raise their hands, but and how many of you actually have 6 months of, cash and in an emergency fund right now? I know for a fact that I don't. I'm probably around that 3 month mark, just because I've had to reinvest in my own
Yeah.
businesses. And also, help take care of my parents. So, I think again, that's sage advice, because
Yeah.
that again, as you're sort of setting your life up, these are the goals that you sort of need to sort of, focus your energies and clearly focus your money into, as opposed to just kind of hoping that things, stay
Yep.
good. It's not a good way to live. Trust me when I tell you this. I've burned myself
Yeah.
down many times financially from not having a little bit of an egg put away somewhere, because
Yeah.
inevitably, you get into a 3-car pileup.
Yeah.
Ding. So, so that totally makes sense. So, since we have a couple of minutes left, I want
Yeah.
to give you an opportunity to sort of, tell people about the sort of gift that they get for being on the
Yeah.
call today. And I think this is something that is super duper valuable to you guys. And I'm so glad
Yeah.
that your company was able uh, to um, to offer this to us. And then on top of that, a tribe, and I'm gonna be partnering with Scott as well to actually sort of blow out some of the gift. I'll let him talk about that first, and then
Are you able to sort of call it up on the screen, what I say?
yeah, I believe if you want to share your screen, you're more than welcome to do that as well if you'd like.
Let me see if I can find what we're talking about
Oh,
here.
okay.
Let's see. This may take a minute.
No worries.
So as I'm looking, I'll try and speak to it.
Yep.
So our firm was founded on 3 basic principles 20 years ago. The asset management everyone knows about, right? It's more the education and the financial planning. Those are 2 what we think the most important things that families are needing now more than ever. And so we rolled out in the last year or so, I think I found it. Let's just see here. We rolled out an education and curriculum. And what we're able to do, so it's not, you need a whole bunch of money. It's basically a lot of courses and curriculum that are really helping you better understand and educating you in the process. And so we have a couple of them. I don't know. So basically, there's ones for like the beginning, which is called, I guess, sort of pathways, the very beginning stages. Then there's foundations one, also on the kind of front end of your life. And there's one that's called legacy, which is sort of later.
Perfect. Well, Scott, thank you so much for giving us your time today, and kind of walking us through and dispelling a lot of a lot of myths, and dropping some knowledge. If anything, it makes me even more excited about the process of investing,
Yeah,
and makes it a little less, I won't say scary. I've never looked at it as
yeah,
scary. I've just looked at it as, if I don't understand it, it's not sexy.
yeah,
And again, I think the more we continue to educate and continue to give people information about it,
yeah.
people are able to sort of do their own sort of research and find ways to make this less scary or to make this less daunting, and hopefully get rid of a lot of the BS that we were fed on media.
I wanted to send everybody off with one last comment because I
Yeah.
think it's really helpful. And again, I think you just put it in your pocket.
Yeah.
And that is, I believe the foremost dangerous words in my industry are this time is different. This time is different. I was hearing this in the tech bubble before it exploded. You had technology companies that didn't even have $1 of revenue that were, trading at $200, $300, $400 a share. This time is different, they kept saying. This time is different. In fact, Warren Buffett, who's one of the most well-known investors out there, his Berkshire Hathaway company was at a 10-year low. They were calling him a dinosaur. He should be in technology. This time is different, yada, yada, yada. Well, we all know how that ended, right? The NASDAQ went from 5,000 to 1,100. The point is, this time is not ever different. And so what we would do in the flip side of that is think about the terrorist attack. And when that happened, nobody wanted to fly, nobody wanted to invest. I'm never going to invest in a stock again. This time is, Scott, listen, this is unprecedented, Scott. This has not ever happened before. We're never coming back from this. This time really is different. What I would ask everyone on this phone, the Zoom call to do is what we ask families to do is interchange those words out with this time is different with this too shall pass.
Bless you. That's fantastic. And it's true. It's true. So thank you again, everyone, for attending. Thank you, Scott, again, for giving us some amazing information to work with. And, do with it what you can, you guys. The recording of this will be out there. Feel free to reach out to Scott. Thank you, Maggie, for posting his LinkedIn information. And, reach out and let's keep this conversation going. And like I said, with Scott, I will bring him on again, actually, and maybe dive into some really specific stuff going forward, just because, again, I think with consistency, it sticks. So there you go. Thank you again, everyone, for joining yet another Tribe Ask Me Anything. And we'll be back again with another one very shortly. Have a great day.
Sure.